Hey, future millionaires! Today I'm bringing a detailed video about how to grow your stocks portfolio from scratch. This is ideal if you have little to no experience with the stock market and are looking for ways to either get started investing or growing your portfolio to the 10K mark. Why 10K, you might ask? Why not 100K or 1 million? Because growing is all about setting goals, and I believe that initially you'll want to hit milestones along the way that will leverage you for achieving the bigger goals, such as growing your portfolio to 6 or 7 figures. In turn, this helps you stay motivated and keep looking for more, rather than having a gigantic climb ahead of you, which typically makes people give up too early without realizing the potential ahead of them. So, to accomplish this 10K portfolio goal, I will use the growth strategy, which can help you grow faster in a relatively short amount of time. There are other types of strategies such as dividend investing, which I will cover in another video. In this case, since I want to get the most on my initial investment without having to actually come up with a high sum initially, I will be sharing how to structure your portfolio, what categories to invest in, and how to do so while mitigating risk to help you on your way up the stock market. And the best of all is that you can get started with small amounts. Instead of having to come up with thousands of dollars right away, you can simply start with $50 at a time every week or every month and continue building from there. Now, let's get started. I want to start by explaining my investing approach, as I am not a day trader or any sort of short-time investor. And that makes a whole lot of difference when you are getting started. My investing style is long-term, and by that I mean 2 to 3 years on average for each stock that I buy, and what this does is it allows the values to come to maturity rather than exploiting small swings in the short term. Now, you might be wondering, how do I make sure that after 2 to 3 years the price of that stock is actually going to be higher than what I initially paid? And the short answer is, no one knows how. Not even AI can predict such things, yet. But there is a way to minimize risk and concentrate gains over the pass of time. And that is by dollar cost averaging. See, when you buy a stock once, you are only getting a good deal once. If instead you continue to buy any time that stock dips, you end up getting a good deal multiple times along the way, and the best part is that chances are the price will go up eventually. This ensures you catch that stock on the low end and build your position with an average purchase price below what it's currently worth. Stocks might dip for a multitude of reasons, related to company performance, expenditures, new management, or even global or national events such as economic collapse, wars, or any pandemic as we experienced a few years ago. And this also ties back to how much you believe in these companies. After all, you are acquiring a tiny portion of that business. If you don't trust it and have not done your research well enough, it's going to be harder for you to remain strong when you see that stock price go down by 50 and sometimes even 90%. It's a decision you have to make from the time you buy it and remain committed in the long run. And many of the greatest and richest investors do it this way. Sure, you'll get some self-made millionaires trading stocks, but I don't see any of them being in the top 10 or even the top 100 richest people on Forbes. Instead, I do see many long-term investors who've accumulated fortunes by building a portfolio over time using this very same method day in day out. So, to my initial statement, by dollar cost averaging you always ensure to get a consistent purchase price for that company you are getting into, and continue to add in increments over time to build that position. Let's use the real case study of PayPal, a stock that I own 77 shares. The first time that I purchased this stock, it was down from their $300 plus heights to $110, but because I am still interested and I believe in the fundamentals of their business, I know that eventually, just like pretty much the entire stock market, PayPal will bounce back to where it used to be, so I kept on buying it even when it was going down. You might be wondering, how am I certain that the stock won't just plunge forever? And for that I will quote Warren Buffett: buy into a company because you want to own it, not because you want the stock to go up. Now, obviously, you do want the stock to go up. After all, you are investing into it to make money, just as if you were buying a business. No one invests to lose money. But don't do it solely with that purpose. Once you understand what you are getting into, it makes it easier to navigate the ups and downs without so much uncertainty. And that is the whole point of this strategy, to put you on a road of certainty while you build a position in investments you believe in, and that will continue to grow over time. So, by buying shares over and over consistently, I ensure a lowest price on average rather than trying to time the market, which is statistically harder and would require a lot of time, energy, and could make you lose money. With this same strategy, my current average cost for PayPal is $84. This is over 70% down versus 1 year ago. For some, this can be discouraging and scary. To me, this smells like opportunity. Now, let's pretend that this rebound happens after 2 years from my initial purchase. After that period of time, I would have made almost 3x my initial investment. Meaning if you had invested $5,000, you would then have $15,000, and so on. In this case, that would be a 300% return on a stock that, like many, is beaten down. Break that number into 3 years and you get an average of 100% year-over-year return. Those are solid numbers. Now, let's think of the worst scenario where the price doesn't go up until 5 years after you bought the stock. The return would still be a solid 60% year-over-year. Still not bad, huh? So again, if you had 10K in year 1, by year 5 you'd have 30K. Even with the most fierce of inflations, that is a pretty nice return. And here comes my next point. Yes, you are obviously doing this to grow your wealth and to expand your portfolio, and you might have a couple big goals in mind. Maybe it's a house, travel the world, buying a Lambo, or having a pony in your backyard, up to you. But the nice thing about using this system to invest in stocks over the long run is that oftentimes you don't need to sell your entire initial investment. And that wouldn't be ideal either. You should always try to preserve part of your wealth so that it keeps growing. Otherwise, you'd have to start from scratch. Another reason why you might want to look at investing at least over 1 year is the taxes. See, capital gain taxes can determine how much profit you bring home after you sell your stocks. This means that if you buy a stock and keep it for under 1 year, you will be taxed at the same bracket you're in with, let's say, a job. This because it falls under short-term capital gain category. This over and over ends up eating a big chunk of your profits, whereby just investing over a year, you can save more on the taxes and recycle your earnings into other purchases, prolonging this way how much you are paying to Uncle Sam. Now, I hope by now I have been able to paint a clear picture in terms of how to invest for the long run, and more importantly what type of mindset to have when entering the stocks bullpen. In summary, you will want to take advantage of the times where stocks are down to build your positions by acting in the opposite direction of the masses. This might seem counterintuitive at first, but it's the fastest way to stack your portfolio in a safe manner, in a relatively small period of time. You can do this with any stock, ETF, or even crypto if you're into it. Fortunately though, the market is still down from its 2021 highs, which makes it even easier to use this strategy across multiple industries and still get an above-average return on your investment. The bottom line is, don't try to time the market, instead focus on time in the market. And you too will see your portfolio grow. From there, if you are looking for an alternative way to invest over the long run, without ever being concerned about if a stock goes up or down in value, and rather prefer to concentrate gains over time and even reinvest those gains, I have a video that covers all of that in detail and tells you how to scale your dividend portfolio over time. If you find this content valuable, please like and subscribe and share with your friends. See you next time.